Welcome to Real Money Talks. Real strategies from the moneymakers and the world changers that you can use to make millions, keep those millions, multiply your wealth, and build your team. Here's your host, author of 5 New York Times bestsellers, money expert on Dr. Phil, CNN, CNBC, The Street TV, Fox News, and The View, Laurel Langmeyer.
Hi, this is Laurel, and welcome back to Laurel's Real Money Talks. We're talking about making money, keeping money, and investing money. Those of you who were not with us over the last few weeks over our podcast, I just recorded a 2-day Blitz. So we will be putting up a Blitz podcast, and it is quite lengthy. So it's totally out of the norm. It's 2 hours. So look for that in my laurelsrealmoneytalks.com. There's some makeovers and really goes through the millionaire matrix. Today, though, we're going to focus on one part of the matrix, which is how do you invest your money? And we teach all off Wall Street asset investing. And my partner, Jesse Brewer, is with me today. So welcome, Jesse, to Laurel's Real Money Talks.
Hello, how are you?
Good. So talk a little bit about you. Just give some background from the Cincinnati, Northern Kentucky area. Actually, we do more of our work in Northern Kentucky. I know you grew up in that area, but you've built a multi-million-dollar real estate portfolio, done funds. Just talk a little bit about your background, why you picked real estate, and why are you there?
Well, more millionaires are created in real estate than anything else. I mean, that's no secret. I kind of just grew up in it and fell into it. So my background, I'm getting ready to turn to base 4-0 this year in May. I know I'm a puppy compared to a lot of folks that's going to listen to this. I've been doing this since I was 22 years old. I kind of grew up in the business. My dad owned some real estate and some investment property and kind of tinkered around with that. He didn't really have a lot of property, but he had enough to keep him busy. And he was more into mobile homes. Decided when I was 21 years old, heck no way, not for me. I got a real job. I put air quotes around real job, right? I was a police officer, which was my quote unquote 9 to 5 because I worked night shift. So I never really had the true 9 to 5 hours, but I was a policeman for 5 years and I liked the job a lot. I felt like I did a lot of good there. But, 5 years and 2 kids later, I started buying rentals. And then when I hit about 5-year mark in police work, I'd had about 30 rentals. I had 2 kids. I had just gotten a real estate license because I was representing myself on transactions. And I was working nights and weekends and holidays. And that's when it kind of all came to a head and hit me. And I said, I need to go full time into this business. And so I did. And I never looked back.
And so you've gone through a lot of strategies. And I think, we just did this, Blitz that we're putting up. And you were on for a while, and we did a poll that 83% of our community, and it's hundreds of thousands of people, are interested in real estate, number one. So we have a massive interest out there. So I want to start with a broader perspective. There are so many strategies people teach, and everybody starts with wholesaling like it's some easy game. And then there's a lot of, like you said, residential fix and flips and fix and holds. And then there's the small commercial where you've, niched into that. Because it'll kind of speak to the different kinds of real estate you can get into, and then specifically we'll talk about why you picked your niche.
So there's all kinds of different types of real estate, the wholesaling, and I started doing the wholesaling racket when I was starting off. I did some wholesaling back when the market allowed it, and then I also did some turnkey stuff, whether the stuff is kind of ready to go. I always joke with people, I was doing turnkey rentals for folks before anyone knew what turnkey rentals were. We didn't have a name for it. We just said, hey, let's get this property, let's fix it up, let's put a tenant in it, and let's sell it, and let's manage it, which is the turnkey model. But we were doing that before it blew up and became a big thing. And then obviously it kind of taken some bumps and faded, but that's a different story. So I started off in the single family racket, and I call it a racket because it was a grind. Because I'm an owner-operator. I'm not a passive investor. So I was bouncing all over, running around, just properties were spread out, and it was just logistically, it became a nightmare. So then I thought, someone said to me, how come you know about multifamily? And I never really thought about it because I was always into single family rentals because it was an easier barrier to entry in the market. It was a lower barrier of entry. It was a lower cost. So long story short from that, I was, that's how a lot of people start. So I'm like, well, okay, let's start looking at some deals. Started looking at some multifamily deals, sold a couple of single families. And so I started doing 4 units, some 8 units. And then lo and behold, kind of fell into my niche there between that, 4 to 20 unit space. Sometimes we go a little bigger than that, but we tend to stick between the 4 to 20 unit type properties. And my reasoning for that is because when you get to the 20 unit properties around that range, even a little bigger, they're big enough to where you're not bidding against everybody who watches HGTV and thinks they want to do real estate. The single family market, people always watch HGTV, flip this house or whatever. They think I can do that. And that's who's been the single family. So you weed out that competition, so to speak, that's going to drive prices up. But you're small enough where the bigger people, the ones that only buy 100 plus units, the more, institutional buyers, they're not looking at that smaller stuff. So it's kind of like an in-between space that I've found to where I don't have the bigger competition coming in on me, and I don't have any idiot with a hammer and a cable television box that thinks they can flip a house bidding and driving the price up.
So true. So talk just about your market. Like, it's such a unique market. I shouldn't say it's recession-proof, but it has a lot of economic power to it. So talk just about your market and the kind of market and what makes it that.
We're a cash flow market. Back when everybody was spiking in 2003, 2004, 2005, we had some increases, but nothing like you guys have on the West Coast or I was on the East Coast. We didn't shoot up stupid amounts. So therefore, we didn't crash stupid amounts on the crash hit. Did we take some bumps? Absolutely. Everybody did. And we have pockets here that have shot up more than others, like everybody else does. But for the market as a whole, we've stayed pretty solid with the economy. We followed the national trends, but, we're not spiking up 75%, then spiking down 75%, and everyone losing everything. We're a little more conservative here in the Midwest. A lot of the banks are more conservative here in the Midwest, too, as far as, with skin in the game, so to speak, down money's put into properties. So, and that's going to help insulate us a little bit. Employment is good here. Cincinnati's got, I think, 8 Fortune 500 companies headquartered here. And you got to realize our MSA, the Cincinnati MSA, the Metro statistical area, encompasses parts of northern Kentucky. Like right now, I'm sitting in my office in northern Kentucky, but if there was a baseball game going on and someone hit a home run in downtown at the Red Stadium, I'd hear the fireworks. I mean, we're right on the border. So, the MSA's only got 2.1 million people. So it's not like we're overcrowded here. So there's a lot of employment. Amazon's coming here. Amazon just put a $1.5 billion investment into the Cincinnati airport, which is actually in Kentucky. The airport's just across the river in Boone County, Kentucky, which is where I live. And that's going to be a lot of jobs. It's a lot of growth. And there's just a lot of that type of stuff going on. Procter & Gamble's here. Kroger is here. I can go on and on and on. So there's a lot of work. It's affordable. The average cost home in Cincinnati area is $157,000. That's the average. I mean, that's taking into account the $10,000 homes that you buy in the auction steps to the $1 million plus estate homes that you can buy, suburbs. So that's really an affordable indicator that we have a good cost of living here. Combine that with the jobs situation, it's got a lot of the perfect storm, if you will, to be a good market. Now, there are other markets like ours across the country. I just don't know them as well, and I happen to be from and live in one, so that's why I stay here.
So talk about your operation. You do, like I would say, what I did way back in the day that made me a millionaire, made you a millionaire, is because you became a full-stop shop. There's so many, I'm going to call them investors, agents, brokers. They do one piece of the pie, and they hire everything out, which to me is giving away cash flow that could have been inside their shop. When we say you're one-stop shop, what does that mean?
First of all, to have a property management company, you have to have a real estate brokerage. You have to be licensed. So we have a real estate brokerage, and then in that real estate brokerage, we have a sales and acquisition arm, and then we have the management arm. Now, it's one big company behind the scenes, but we run it as two separate divisions because they're two very different things. But obviously, one feeds off the other. So, and then the third arm, which is kind of like, if you picture like a hierarchy chart, you got the brokerage up top, and you got the little lines coming down. You go to the left, you got brokerage. You go to the right, you got management. Then if you go below management, you have like project management. That's where we do all the renovations. That's where we're putting the roofs on the buildings, getting the windows put on, and things of that nature. And then on the brokerage side, we have a marketing arm, and that marketing arm does nothing but crank out letters and make phone calls out of the database looking for deals. Because we don't buy deals on the market typically. I would say out of the last 20 properties we've done, I would say maybe 3 of them have been in an MLS type situation. Most of the stuff that we find is off market. In the commercial world, they talk about LoopNet. If you ever know what LoopNet is, the national MLS for like commercial real estate. And the joke always is, if a deal goes to LoopNet, it goes there to die. Because in this market, anything that's good, you found a buyer. I've got a slew of buyers that want to buy. It's just, we really need to focus on the sellers and convincing the sellers that they want to sell.
So let's talk about how, I know you've done funds. We actually have a non-accredited fund, which we can't talk like all about our details, but people are interested. Jesse does do these extraordinary funds, 4 plexes to 20 plexes. So just in general, talk about some past funds and why they work.
So I get a lot of folks that want to invest in real estate, but they don't want to be landlords. But they don't want to necessarily park their $50,000 they've got into some big, gigantic REIT and get feed to death on or whatever. So the alternative is to find folks like us, and we do small private placement funds. And last one we did, we raised, I think, right around $500,000. And it was just under that because we had a cap on it at $500,000. We came in just under that by the time we rolled. And we went out, and it was an equity fund. And there's 2 types of funds. You have equity and you have debt. And I'm not sure how in depth you go, Laurel, but I can dig into that for a second if you want me to between equity and debt.
Absolutely. I think it's important. There's a big, big distinction. We want to talk about that.
Okay. So a debt fund is you're going to get a fixed rate of return, 8%, 9%, whatever. So no matter how well the fund performs, you get that 8-9% return. So, and some folks like that. They like that. It's safe. It's predictable. That's what they want. But then the others, if you're like me, you want a piece of the action. You're willing to roll the dice a little bit. You want equity. We really like equity funds because you're along for the ride. So if you own 10% of the fund per se, and we exceed expectations on our rate of returns, you get 10% of the profit after, capital return. So I prefer equity from a sponsorship standpoint. I know a lot of sponsors prefer to raise debt, and most people that do this full time, they prefer debt because they know how well it's going to perform. They know what they can do. So for the sponsor, they would rather you pay debt because they're paying you peanuts on what they're going to make. I prefer equity because everyone comes for the ride. Everyone wants to invest again. Everyone seems to be happy with that.
So talk about the differences in the play. So equity, what they get, debt versus what they get.
So the last one we did is an equity fund. So we raised up this money and we went out and we purchased a few handful of properties. We purchased a 2-unit. I purchased a couple 3 units, and I purchased a 4-unit with this pot of money. And they were all in disrepair. So we went out and we purchased them for cash because part of the idea of the equity fund is we're not leveraging the money. I mean, there's a million different ways to set these things up. So you need to pay attention as the investor. Can they leverage the money? Is one of the first questions I would always ask. So we do not leverage. So there's no first lien position where we're going to lose the property to the bank should something go nuclear. At the end of the day, we own the asset for better or for worse, which means there's always something to liquidate and return should things go bad. That's why I know a lot of those types of funds, they'll say, hey, we're raising debt, and then we're going to leverage it into a down payment. So that's not our model. So we bought these properties for cash, no debt. And then we're going to renovate them. So we renovate these properties, and usually they're very disrepair, mismanaged, bad tenants is usually the number one factor. You got bad tenants that are living in bad conditions, so they don't really like to pay their rent. You got bad roofs, bad windows, 1950s carpet and countertops or whatever. So our MO is we go in, we identify if there's any tenants worth keeping or not. And then sometimes there are, but usually most people wind up moving out. And then we come in and we do a full-blown renovation job. And Laurel, you saw one of those on the tour here, the 4-unit that was behind my office. You and I wound up selling that to a community member sometime later. That was on the tour, actually. So we come in and we put the butcher block countertops in. We put the new cabinets in. We put the new flooring in because we know what the market rates for the rents are. That's one of the advantages. Whoever you work with, you want to make sure they know their market. I live here. We're very insulated in this market. I know what a 1-bedroom rents for. I know what a 2-bedroom rents for. I know what a studio rents for. You guys met my leasing manager, Mike, when you guys were here. I mean, he's a walking encyclopedia like a rent index. He'll tell you what's included and what we can get. And that's important when you're going out and looking at these deals because that's how you identify the value add opportunity. You need to say, what can I push this to get the rate of return we need? So we go in, we blow those units out with our renovation teams, and we re-tenant them, and we get them performing, and we get the money coming back in. Because we're buying all cash, because we're renovating, though, typically you don't get any return back year one. It's all money going out. You might, but you're outlaying a lot of cash because you're not leveraging the money, and you're buying the buildings, you're operating them, and you're putting this money into them for the heavy renovations. Well, after you turn that corner, it's usually a nice tax write-off year one because you get a piece of the equity, so you get a piece of the tax write-off as well. Once the money starts rolling in, then when you're positive cash flow, that's when you do like quarterly distributions out. Does that answer the question, Laurel? Or did I get off topic too much?
No, I love when you talk a lot. So the other thing I want you to talk about is like you've kind of niched in because of where you buy and on the river. And I know you love me talking about it, but you're the first one that brought it up, which is how you really rehab for millennials and what that really causes. Okay. What's your strategy on that?
So I like urban properties. It used to be people lived in the city because they had to. And like here in the Midwest, when people moved out of the city to the suburbs, but now they're wanting to come back. Now they want to be near the bourbon bar. Bourbon bars are very big here. I'm not sure about it. I know out there they're not. Every time I come out there to find a decent glass of bar with bourbon is like a needle in a haystack. But here, we like bourbon. So bourbon bars have become really popular. Coffee shops, boutiques, things like that. So I like to be in the area where that stuff is opening up. Not so much chainy restaurants, but more like the boutiques, like the one-offs, like the place we had dinner, Laura, when you were here at Hotel Covington. A lot of places, like I could be areas where near that stuff is opening up because that's where the millennials want to be. The millennials, they're, I think, 34 now to, I don't know how young they are. I'm not doing the math, but I think they're I guess they'd be 24 to 34, give or take. Because, there's all kinds of different statistics. Like you got the Y generation, you got this and that. But for all intents and purposes, millennials are hovering around 24 to 34 years old. So I have to think, what does a 24 to 30-year-old do? What do they want? They're not getting married right away. They have a job. They're educated, bouncing around. But what do they want? They want to walk to the bar. They want a $5 Uber ride to a cool part of town. They don't want to take care of a yard. They're always on the go. They're dating more. They're not getting married. They don't have as many kids. And this is important because there's like 75 million of them. They're as big as the boomers. We got to understand them as a renter. And that's what we try to cater to. I try to give them like a nice product where I'm not the nice A-class property that's charging me ungodly rent. I'm the next step down that's like a block away from them. That's clean. It's got some cool features. We put USB ports, electric outlets. It's a $10 upgrade in the kitchen, every bedroom. And people love that. It's like $10, because they live on their phones. They're glued to their screens. They're glued to God, what else. And so we try to cater to that as much as we can to attract that tenant with location and with amenities, butcher block countertops and stainless steel looking appliances. So they want that sleek look. And then maybe on a little bit of a budget. So that's where we buy the property right, and we know where we can maximize the value.
And the rents alone, you keep saying you're in a cash flow market. What makes it so powerful? And you have a very interesting strategy on really forcing appreciation through higher rent. So talk a little bit to folks. I think your millennial strategy is really unique, and I think the way you force up rent. And people listening that's rent are going, I don't want my rent forced up. Well, on the other side of it, this is how it gets done.
So, when you buy a single-family home, your appreciation is tied to what the neighbor sells for because that's what the market says. Even if you have a single-family rental and you're killing it on rent, but you're in a $50,000 neighborhood, you're not going to be worth more than $50,000. When you get in these, 10, 20-unit properties, even bigger, on a bigger scale, you can force appreciation by increasing the cash flow. So when I take a property, let's say it has an average, and yes, these are real numbers, $500 average rent for a one-bedroom. I find this all the time. I know if I come in there, I'll give you an example of one that we did, and I'll keep numbers rounded. It was a 10-unit property. The average rent was like $500 a pop. Some were a little more, some were a little less, but that was the average rent. So this thing was spitting off $5,000 gross a month. $60,000 a year. After its operating expenses, I think it was hovering because they paid the utilities right around $22,000 a year. Right? Not bad, not awful. We bought it for about $150,000 because it needed some work. We put in maybe another $50,000 in renovations. And I was able to take those $500 rents on average, and I pushed them to $725. But because there was a value add there, because I knew what I could do. When it's up that much, now your gross rent is a lot different situation. And I think when we put it on, the cap rates, I'm not really a cap rate driven investor, but, cap rates kind of indicate rate of return, sort of. So, an 8 cap is probably a decent cap rate in this market right now. So when you put those numbers on a cap rate, we damn near doubled the value of the building, what we had in it, because we were able to identify the opportunity and force that appreciation through the rents within an 18-month period. And we didn't have to wait for some big 2006 spike boom for stuff to sell like crazy. We were able to do that because we were able to put the sweat equity in. And because it's a commercial property, which the value is income driven, we were able to accomplish that.
Well done.
We do that a lot. I do that with a 4 unit. I could do that with an 8 unit. I've done it with 50 units. I got a property now that's a little bigger than average, that we normally deal with. It's a 34 unit that we took it over, and the average rent was $425. We put some serious money into it, and now we're leasing them out at $625. So it's all just zeros at the end, but that's really where I like to focus my model, and that's why I like those types of properties, because when you're in the urban area that we are, you don't have 100-unit complexes, just because that's not the way this area is built. You get 4, 8, 10, 12, 20 units. And so our strategy is we have an office down here. We stay centered to our office, and we just play in our sandbox. This is my sandbox. I try to dominate my sandbox. I kick the other kids out of my sandbox if I can.
And talk a little bit about your sandbox, because I think there's a huge mistake. I see it in our community a lot. People say, well, I'm across the nation. So talk about the benefit, I think, but you and I both believe, of running your ranch, knowing your sandbox, like every square inch of that area, and just the pros and cons of staying in one area and really commanding it versus going national. And you got a little bit of crap here, a little bit of crap here. Number one, I'm just going to say management's a nightmare. So
yeah, I don't want to step on anybody's toes or bash anybody. So what I'll say, if someone tells you they're in 7 different markets across the country and they're going to diversify your portfolio, they're full of shit. I'm just going to say it now. I'm sorry to cuss, but I know we're being recorded, but they're full of it. They don't know the market. There's no humanly way possible you can get to somebody and get a level of service that knows what they're doing in 7 different markets unless they have a staff everywhere, which means they have more overhead, which means you're going to get feed to death. So I don't like that. I know my market, and that's why I'm here. Other markets like mine, yes, Kansas City, I read, is a good market to be in if you're in the Midwest. And there's a couple, Texas has got some great markets. But every market, when it looks good on the surface, when you start digging in and peeling the onion back, they've got their bad sub-pockets. And so where the value comes in for someone where you stick in one area is the sub-markets. You really need to know those sub-markets because that's where you're going to win or lose. Well, in my market, you can go 4 streets the other direction, and you're like, holy crap, I'm in Beirut. I don't want to be here, And then you go 4 streets the other way, and you're like, I'm ready to move here. So it's really important to know that sub-market, to know what streets rent, to know what's by what development's going on. And that's how you really maximize your value. Because every market, when you're sitting behind the computer looking at the Google and you're looking at like, okay, this market looks good, this and that, I can find statistics on any market to show you, hey, you should invest here and find pluses. But it's when you peel back that onion and you really dive in, that's where you start to get the value. And the only way you're going to get that value is to get to somebody that is entrenched in that market or become entrenched in the market yourself.
I love it. I love it. And I totally agree with it. And I think it just scatters. It breaks my heart when I hear these, clients that have one house here, and they're $300,000-$400,000 houses. They're not cash flowing. So Jesse, any last words? Talk a little bit about the stock market, little dip we're so happy about, because our goal is to wake all of you up that are sitting around in the stock market, parking your money, praying to God something's going to happen with no strategy. And we want you very interested. If you're interested in learning more about the kind of real estate, the different funds, just what Jesse does, you can actually, I'm going to put out an email. I'm going to go to Dave. So Dave Hare, DHARE77 @gmail.com. DHare77 @gmail.com.
Dave really likes all the chain letters you guys can send him to. Show him some love with that.
Exactly. So just say, I'm interested. He's also a cross-border accountant. If you have tax questions about, how things like this work, Let him know. Also, if you just want to ask any question, make a request, go to asklaurel.com. That is always where folks go. Put in your name, your phone number, and your email. And if you would say, I want to call with Jesse, I want to talk to Dave. But if you're interested also just in learning about fund paperwork, a lot of times people, you've never seen fund paperwork. So again, you would get that from dhare77@gmail.com. He can send that out to you and you can learn more about this. Last thing I want to say, mark your calendars. Jesse and I are doing a tour April 24th and 25th. We will be in the market. Our advanced students are coming in day in advance, 23rd, 24th. But if you would like to come to the market, you can bring your checkbook. It's a buying tour and come see how this is really done. We put you on a bus. We meet the team and educate you on deal structure and how real estate gets done. So mark your calendar. You can always email Gabe also, GABE@liveoutloud.com. Learn about the tour that we are headed into Ohio in April. Jesse, anything else to kind of end our podcast today?
No, you pretty much covered it. I mean, you touched on the stock market a bit, and I think we're all just kind of waiting to see what happens there. I'm not waiting to see what happens because I'm not into stock market that much. And I'll say this. What goes up is going to come down. And the stock market has done nothing but record gain. So, and there's nothing to really back it. It's all paper. When the stock market starts to drop or starts taking some uneasiness, the money gets scared. And when the money gets scared and gets pulled out of the stock market, it starts going into real estate at a higher level. So what you're going to see is you're going to see a lot more institutional money coming in at a higher level, which is going to compress down. The good thing for us in our space is we're 12 to 18 months behind the compression. So getting in now and getting a hold of something now, you got a chance to ride a wave a little bit when that compression starts to feed our way down to us.
Exactly. Jesse, I appreciate you. Appreciate you being my partner. Looking forward to seeing you again. Well, we'll see you at the big tables, but we'll be there in April. So if you're interested in the tours, email Gabe, GABE@liveoutloud.com. And just say, hey, I want to go to that tour. I want to understand what it's like in those markets. And let's stay in touch. Real estate, like Jesse said when he started the podcast, everyone who's a millionaire owns some real estate. And I love the real estate in Ohio and look forward to doing business with all of you. So you're on Laurel's Real Money Talks. And Jesse, thanks for being my guest today. And we'll be back with more conversations about money, how to make it, keep it, and invest it. We'll be back. Talk soon.
Thank you, Laurel.
Thanks, Jesse.
Thanks for listening to the Real Money Talks podcast. Your host has been Laurel Langmeyer, author of 5 New York Times bestsellers, money expert on Dr. Phil, CNN, CNBC, The Street TV, Fox News, and The View. Want to learn more about off-Wall Street investing, tax strategies, and multi-million-dollar business strategies? Visit laurelsrealmoneytalks.com for past episodes, show notes, and resources. For some special wealth-building gifts only for Laurel's podcast listeners, visit laurelsrealmoneytalks.com/podcast gifts. Do you have a burning question for Laurel? Visit asklaurel.com to submit your question, and it may just be covered on a podcast episode. So stay tuned and be sure to subscribe to get new episodes every week.